All right, good afternoon, good morning, good evening, whichever one suits you right now. Welcome to the MSMF Wealth Management January 2025 podcast. 2025. That's
already 8% done with the year.
I'm trying to wish people Happy New Year when I meet them and see them in meetings. I'm like, January's over, Mark. I'm like, well, okay. So again, welcome. We are going to dive into a topic today that we're hearing from a lot of clients. We got a lot of things going on right off here at the beginning of the year. So we're going to do kind of what I'll call a market mailbag tour. We're going to talk about all these questions we're getting about all these various outside noises and how it could impact the market. So welcome, Jay. Welcome, Cody. We have a new face in the room today, Matt Dallas. Thanks for coming in.
Thanks for having me.
Matt is a CFA certified
charter holder.
Chartered financial analyst, as well as a CFP, like the three of us. He's the head of our internal investment team and really handles almost all of the market research, security research, heavily involved in how we construct portfolios. And we're going to talk about a lot of these outside noises and kind of, Dallas, what we're seeing, what you're seeing, and how that impacts kind of, how we coach our clients relative to their investment portfolio. So I want to start out by saying, there's a lot of new concerns about things that have come up, which the guys are going to talk about, and a lot of old concerns that are kind of new again, right? We're still hearing conversations around the Fed and interest rates. And we've kind of beat that into submission. I think y'all know our opinion on that. There is still a little bit of Fed watching that's going to go on yet this year. Don't expect the rapid pace of change in interest rates we've seen in the last few years. Not that it won't be a factor, but there may be some other more important factors. We've talked ad nauseum about the expiration of the Trump tax cuts. I think we all agree there's no political capital to be gained by raising taxes on Americans at this point. So fully expect those to be extended. No guarantee. Don't know that there'd be a big mover and shaker on the economy and the market. Maybe so, maybe not. We've talked a lot about the impact of energy and oil production. We expect that to expand under the new administration. Not really going to get into that right now. We've also had a lot of conversation about, oh my gosh, we're at these market highs. Should we still be investing? We have talked to a lot of you in our individual meetings. Just to the short of it, there's a JP Morgan slide and some information we can share with you that demonstrates that if you would have just invested on market highs for the last, Craig, how many years?
1, 2, and 3 year time periods.
For how long does it look back?
It was 1980.
1980, you would have been better off investing on market high days versus every other day. So we're not going to worry too much about market highs. We'll continue to share that information with you guys as you come in. We are going to talk about some new concerns that have come up between tariffs, deportations are an issue, artificial intelligence, and then we want to put it in a framework for what that means for everyone's portfolio and their construction and management of their portfolio going forward. So with that as a backdrop, Jay, I'm going to toss it over to you. And you and Dallas can start diving into the conversation.
All right, perfect. So let's start with tariffs. And it's kind of related to interest rates that we talked about before because that was dependent on inflation. And so I think one of the big major concerns people have is if we have a bunch of tariffs that Mr. Trump's talking about, that's going to cause rampant inflation. It's going to affect the economy. It's going to destroy our portfolio. What do you think?
Well, in general, you're talking about tariffs. It's a non-market factor that's going into the portfolio, right, or in the market. So economists don't like that. Generally speaking, you're going to want the market to decide who's the best at making something, and then we're going to go buy from that company, not forced to buy from an inferior company because of some arbitrary law or rule. So that's kind of the focus of why tariffs might be negative on the portfolios, because we're going to end up having to pay more for the inputs to the products, and then we're going to get a less or more inferior product as the end result at higher cost. It just doesn't look good on a balance sheet, doesn't look good on your budget when you're planning for your family. So kind of on the surface of it looks a little bit negative. Reality is we've been having high tariffs for a while now.
since the first Trump administration.
And it has played into the inflation factor that we've seen. It's not insignificant, but I do think that U.S. companies are able to adapt and change. Mm-hmm. And regardless of tariffs, I think we're in the deglobalization process right now just naturally. So supply chains are being affected and changed. And Mark, he shot off a couple of different reports showing the effects of tariffs. They could have some dramatic impacts on GDP. The highest estimate was a loss of 1.4% in GDP based on the tariffs. But like everything in economics, it's all else equal. So
Right.
That means if I need to buy steel, I'm going to buy the same amount of steel from the same person and pay whatever the increase on that tariff is. It doesn't mean that I'm going to change my distributor or I'm going to use less steel or make something more efficient, which will happen. So,
further tax cuts, how would that offset that beyond where we're at today?
as far as
Individual tax rates don't stay where they are; they're actually cut further
well, with tariffs
or abolished. I hear that's a thing now.
Yes, yeah, we'll make.
That's a thing now. That should be the whole title of this podcast. Oh, that's a thing now.
That's
Sorry.
the thing.
The government has to bring in taxes, right? And I don't think taxes will be abolished. There's some principles that just make it necessary. It actually helps. If you go fundamentally, it helps the dollar have value.
Mm-hmm.
If the U.S. requires you to pay them in dollars,
Mm-hmm.
it's basically where you can create a solid reason to own a dollar. But if you look at the tax situation, even if you shift taxes towards tariffs, it comes back to the consumer as higher costs. So what's the trade-off there? Is it better paying a company who's going to pay more in tariffs, ends up back in the government, or paying it directly as the taxpayer? It's hard to say.
I think the big thing, what it seems to look like right now, is that there's not which I think a lot of economists were worried about, is I think he's made it pretty clear it's not going to be a universal tariff for everybody. Mm-hmm. So there's certainly some countries that have been targeted, with Canada and Mexico, but like with everything, he certainly seems to use it as a bargaining chip. So it's all just such big speculation on how it could affect everything. So yeah, it's strange.
And looking at the numbers, you've already said it. We've already had tariffs in the past. This is not a new thing. It's just being highlighted as a bargaining chip,
Mm-hmm.
and that's just reality. That's a thing now.
So, barring going off the deep end with tariffs, it's more of an emotional concern than it is a practical from a portfolio perspective, you're thinking?
I do 100%. Yeah, and another news thing that's splashy and everybody wants to talk about, but it's just everyday policy. That's just the way the world works.
Okay, cool. What you got?
I get to talk about deportation of illegal immigrants. We're getting asked a lot of questions about it, like at the end of the day, what effect is that going to cause? Is that actually going to cause an inflationary wage effect on, if we're deporting a whole bunch of people and not able to fill in those roles, then really the only way you can get people to fill that in is you raise their wages, right? So that's a different type of inflationary thing. And yeah, from the surface, it seems like, okay, well, that's what's going to happen. But, you got to remember at the same time, we're going through a huge technology revolution here in the U.S. And, artificial intelligence and robotics is one of the subjects here. And, certainly, and we're already seeing it, and especially in the farming world here, it's taking less people to get the job done at a more efficient pace. So that's going to continue to keep happening. I think at the end of the day, what it comes down to is people went through a process here to get legally into the U.S. And the people that have done that they had probably there was some suffering that went on with it, and there were some holdbacks to finally get into the U.S. and get the job they want. And now they're having to compete with those people coming in that didn't have to go through that, right? So there's a due process of coming into the U.S. and we're the number one country in the world for people that want to make their dreams happen. And I think it's, it's something that's not new is another thing. We're looking at these stats before and I just find it amazing. Go back 8 years or so and look at Barack Obama was deporting, about 1,000 people a day?
For 8 years.
For 8 years. That was over 3 million people that was deported. And Trump's first time he was in, it was a total of 551,000. So obviously that number is probably going to go up here, but it's not something that's new. I think it's just a topic that is being stressed out about on the news right now. So
yeah. Well, the government's been reporting deportation since 1892. Is that right? So,
yeah.
So yeah, not new. And I think most Americans would agree that we don't want a totally open border. We need some vetting process, and we do need immigrants. But we want them to be working in good jobs with fair wages. I don't think that we need to have illegal people coming over and working for unfair wages to make our stuff. We should have legal immigration. Maybe we can reduce the rules or have some immigration reform around that. But once they get here, have them work a reasonable wage, and I think we can fill the jobs in America with that.
What's the potential implication to a portfolio strategy?
So right off the bat, if you're losing your workforce, you're going to have wage inflation. You're going to, let's say you have a farm and they lose their workforce. They're going to go look for new laborers. They're going to have to attract laborers from a different farm to come over. They're going to want to pay them more. So it can increase the cost of goods, more input costs going in, which is going to either reduce the earnings of that company or increase the cost when you're buying the outputs. So from a company's perspective, your margins are cut into. You're going to have less earnings growth, and that's going to be a slowdown, maybe not necessarily a reversal of earnings growth, but a slowdown in earnings growth as a whole.
Gotcha. Okay. Jay?
Yeah, let's switch a little bit and talk about artificial intelligence, AI.
That's a big hot topic recently.
Especially this week that we're recording this podcast.
Yes. So today is Wednesday the 29th that we're recording. If you remember back 2 days ago, Monday, the market had a pretty volatile day. The reason why is, without using names, a Chinese firm came in and said, hey, they can do even better than the current generations of AI at about 95% of the cost, using outdated technology, in which case that sent a shockwave through just about all parts of it, at least the growth market, but especially firms that are growing through technology and AI. So I'm curious, what do you think about that? How should people defend against this, ignoring if this is even true or not? We won't even touch that. But
yeah, let's just talk about the growth of AI. It's going to continue to grow. I don't think it's going away. We're not going to create some pact where we freeze AI, as some have pushed for. But like every technology, I think it's going to first help augment human ability. We're going to be able to do our work faster, create new things that we wouldn't be able to do on our own before, just like computers did. And we're going to integrate this into workforces. It's going to be hard to tell exactly where this is going to be most applicable. And we may see firms pop up with these huge promises that they can't deliver on and then go away. So we could see some more volatility in that AI tech space. There's a lot of money that's being pumped in there as far as investment. And, whenever you're putting more money in, expecting higher returns, that increases risk and volatility. So it's tempting to say, hey, let's concentrate in these AI firms because that's the obvious future. I would agree that's the obvious future. But once you look at each individual firm, who is going to be the winner in that in the next 2 years, 5 years, 10 years? We have no idea.
Yeah, look at the electric car phase we went through.
Yeah.
Everyone was wanting to start up companies, and really there's like a handful left at the end of the day of of what you'd actually want to put your money into. So.
Or maybe even another one about the .com companies and all of those.
Yep.
If you've got a website, you're taking advantage of new technology, you must be able to produce something. Let's invest in that, right?
Right.
So that's the thing I'm cautioning my clients about is, okay, do you actually know this company? Like, do you know anything about them? Or are you just hoping to gamble and strike it rich?
And we've seen that as kind of a common theme in tech companies where they promise these big results and they can trick a lot of people. Ford got duped by, what was it, Lucid?
Yeah.
They promised all this different technology in their electronic vehicles and autonomous driving, and really under the hood there was nothing there. Obviously we have countless examples of that in the tech industry, because there are things that the average person may not be up to know enough about to really be investing, but it sounds so promising. It's the returns can be so big. So,
Right. So Jay, I'm gonna throw you a curveball, just real quick off the top of your head, because I know you track this and follow it a lot. Just for our engagement with our clients, where do you see AI fitting in with our business and how we serve our clients and deliver information and advice?
Yeah, I'm glad you asked. I am so excited. I am the one of the population that's super excited about AI and how it can help us bring a better service to our clients.
Sure.
And so, not replacing people or anything like that, but more of how can we automate a lot of these things that we're doing by hand,
Right.
so that we can really provide a really cool experience, knowing exactly how you're invested, for example, or helping visualize your estate plan in just a click of a button instead of it's very manual right now. All those summaries that we provide you as a client, like those are done by hand. That takes a lot of time. What if we could just push a button and do it? And that's just the beginning of this. So there's so many applications that I think can really change our industry for the better.
Right. That's what I figured. And I share your excitement because I think it's a new day in terms of how we ramp up our service to our clients. I look for great things.
Yeah.
We're not quite there, but we are definitely moving there. All right. So to kind of close this up, I know that there are logical things we've talked about: interest rates, tax cuts, oil production, legitimate concerns about market highs and when to invest. But there's been a lot of additional things come up. My perspective, a lot of this is generated by the media and social media on either side of the equation or even in the middle to generate emotional responses from people. But I guess, Cody, why don't you and Dallas share from a very logical perspective, how do we take all this, put it in the funnel, and figure out going forward step by step in 2025 what an effective portfolio strategy is?
Yeah, so I'll take a little of the first stab, but constructing the portfolio and certainly through Dallas's research as we talk through, we really want it set up as a strategy that we implement and put in place that's a long-term investment, that we're not going to make an emotional reaction just because of what could happen inside there. So I think number one is let's take the emotion out of constructing the portfolio. Two, make sure that we're diversified in all areas and that we don't, AI seems so promising that we don't put everything towards that basket. And, I would just have to say certainly this year that I think, there's a lot of unknowns, right? We're all just speculating on what could happen. But at the end of the day, just think of unknown equals volatility. So in my opinion, last year we kind of got pampered a little bit. We didn't have much volatility really to say in the market, even though it was an election year and usually you do get a little bit more volatility. We didn't have that. So I think this year we're going to get emotional about it. We've already seen it in the first month of January, right? So we're having days where the indexes are moving 3 to 4%. Mm-hmm. That's not normal, I would say. It's a little bit outside of the range of what I would say day-to-day volatility would be. But, Dallas, as far as construction of the portfolio and how you manage that, what are your thoughts?
Yeah, so we have an investment team, and we meet once a quarter. We just had our January meeting. Cody and Mark are on the investment team. And the January meeting is kind of the fun one. We like to sit back and speculate. We make guesses about what the market's going to do this year. And then each January, we look at the previous year and see what we got right, what we got wrong. But I'll let your clients in on the big secret. So how this is going to affect your portfolio.
Don't tell anyone.
Yeah.
This is the big secret.
So how this all affects your portfolio in 2025 is the same way it affected your portfolio in 2024 and the same way it's going to affect the portfolio in 2026. So like Cody said, we take longer time horizons, 5 to 10 years. And to get a little bit into the weeds on how it's actually built, we have a benchmark. It's a global benchmark with 80% of the investable universe. We chop it up into 15 segments, and then we monitor those segments and see how each of them are doing, and we take positions and fill each of those buckets. So we're not leaving anything out. We're making sure that everything is in line with a benchmark, and maybe we'll add slight tilts here or there based on a long-term preference. And then inside that portfolio, each quarter, we meet to look at the components in those 15 buckets and see if they're still doing what we're asking them to do. If it's U.S. equity and it's buying international, we're probably going to cut that fund. And we're going to make sure that all those buckets are doing their job and meeting their objectives. That's what we do as the asset manager. On the advisor, he gets those portfolios, and they have a range of risk. So this equity portfolio might have a standard deviation of XYZ. This one has a different standard deviation. And then the advisor can take those and look at the financial plan they've built for the client and say, you can take on so much risk. We're going to use this equity portfolio in this amount with this fixed income portfolio in this amount to make sure your portfolio over 5-10 years is going to hit those risk targets. And that's the most important thing, is the risk side of the portfolio. It's fun to speculate on where the returns are going to be, but that's harder to capture. The risk side, we can actually do a much better job of reducing that downside volatility.
Yeah, great perspective. And just so everyone knows, that's what investment people do for fun. They guess at the beginning of the year. It's not how your portfolio gets managed, trust me. To Dallas's point, and y'all hear us, all three of us talk about it on a very frequent basis. It's all about risk management and trying to control the overall risk of a portfolio that fits your situation, and that's precisely what goes on. All the efforts that Matt and his team put into this is what ends up in what you see us put in front of you relative to taking a gander at your aggregated portfolio and talking about some suggestions for how it should be positioned going forward. So, Jay, any last thoughts?
Stick to the plan. I think it's going to be volatile this year.
Yeah, probably more so than it was. Cody?
Yeah, I mean, kind of touched with everything. Overall, we're here to certainly go back and forth with some ideas. So if you're losing sleep for whatever reason that you hear on social media or on the news, because we do get those calls, and I get it. I mean, I get emotional about stuff too. Let's actually go into the details and see what the facts and how that could affect the overall portfolio, because probably at any given time you're not going to be over engaged in any certain area of the market that we really need to stress about it too much.
Dallas, final thoughts before we lock you back into the research dungeon?
Yeah, I just echo everything that was said. It's all about diversification and having a complete portfolio, not a targeted portfolio with more risk than you probably understand.
Super. Fellas, thank you. Matt, thanks for coming out of the dungeon, the catacombs.
Thanks for having me.
Absolutely. Anytime, feel free. And again, as always, if you have any questions, please reach out to us. Phone number you have, the emails you have, the text line you have. Please reach out. Feel free to share this podcast with friends and family if they have questions, they have concerns. Like I said, a lot of these things are very emotional, but we can logically approach them for what the possibilities are for your portfolio, for the economy and the market, and come to some conclusions, some strategy going forward. So look forward to seeing you guys next month. Hopefully the Blues will have played a lot better hockey than they recently played, and MIZ.